Did you know that millions of high-income Americans are effectively blocked from contributing to a Roth IRA, potentially missing out on hundreds of thousands, even millions, in tax-free growth during retirement? It's a frustrating reality for successful professionals and entrepreneurs striving to maximize their financial future. But what if there was a perfectly legal, IRS-approved strategy to bypass these income limits and unlock the immense power of tax-free growth, regardless of how much you earn? Today, I'll reveal precisely that strategy, the Backdoor Roth IRA. By the end of this video, you'll know exactly how to execute this powerful maneuver, step by step, ensuring you can harness tax-free retirement wealth. First, let's quickly recap why the Roth IRA is so highly coveted. Unlike a traditional IRA or 401k, where you contribute pre-tax dollars and pay taxes in retirement, a Roth IRA is funded with after-tax money. The magic happens later. All qualified withdrawals in retirement, including all the investment gains, are completely tax-free. Imagine investing $10,000 today, letting it compound to $100,000 over 30 years in an S&P 500 index fund, and then withdrawing that entire $100,000 without owing a single penny to the IRS. That's the unparalleled benefit a Roth IRA offers. However, this incredible advantage comes with a catch: income limits. For 2024, if you're a single filer, your ability to contribute directly to a Roth IRA begins to phase out once your modified adjusted gross income, or MAGI, exceeds $161,000, and you're completely barred if it hits $176,000 or more. For those married filing jointly, the phase-out starts at $240,000 and the complete ban kicks in at $250,000. These thresholds mean that many high-earning professionals, doctors, lawyers, tech executives, successful business owners, are locked out, creating a significant Roth roadblock. This is precisely where the backdoor comes in, allowing you to circumvent these income restrictions. The strategy is entirely legal and explicitly permitted by the IRS. It involves two distinct steps: first, contributing to a traditional IRA, and second, converting that traditional IRA into a Roth IRA. Let's break down each step in detail. Step 1. You contribute funds to a traditional IRA. For 2024, the maximum contribution limit is $7,000, or $8,000 if you're age 50 or older. The crucial distinction here is that this contribution must be non-deductible. This means you are contributing after-tax money to the traditional IRA, even though traditional IRAs are typically associated with pre-tax contributions. If you're over the income limits for a Roth IRA, you likely also exceed the income limits to deduct traditional IRA contributions if you're covered by a workplace retirement plan like a 401k. Therefore, this contribution will be made with money you've already paid taxes on. Once the funds are in your traditional IRA, you need to execute the second step as quickly as possible: convert the traditional IRA into a Roth IRA. Ideally, you want to perform this conversion almost immediately after the funds settle, usually within a few days. The reason for this urgency is to minimize any potential investment gains that might occur in the traditional IRA during that brief period. If your non-deductible contribution sits in the traditional IRA for too long and generates earnings, those earnings will be taxable upon conversion, even though your original contribution was not. The goal is to convert the exact amount you contributed, with zero or minimal gains, making the conversion a non-taxable event. Now, here's where it gets complex, and many people make a critical mistake: the pro rata rule. This rule states that if you have any existing pre-tax funds in any traditional IRA, SEP IRA, or simple IRA, the IRS considers all your traditional IRA accounts as one large pool for tax purposes. When you perform a Roth conversion, you cannot selectively convert only your non-deductible contributions. Instead, the conversion is proportionally taxed based on the ratio of your pre-tax IRA money to your total traditional IRA money. Let's illustrate with an example. Suppose you have an existing traditional IRA with $93,000 that consists entirely of pre-tax contributions from old 401k rollovers. You then contribute $7,000 as a non-deductible amount to a new traditional IRA account, intending to convert it. Your total traditional IRA balance is now $100,000, $93,000 pre-tax plus $7,000 after tax. If you convert that $7,000, the IRS will view it as 93% taxable, $93,000/$100,000, and only 7% non-taxable, $7,000/$100,000. You'd end up paying income tax on $6,510 of that $7,000 conversion, completely negating the benefit of your non-deductible contribution. This is a common and costly oversight. The solution to the pro rata rule is critical: eliminate all existing pre-tax traditional IRA balances before performing the conversion. The most common way to do this is to roll your existing pre-tax traditional IRA funds into your current employer's 401k or 403b plan, if your plan allows it. Once those pre-tax funds are out of any IRA, your traditional IRA balance becomes zero, or only contains the current year's non-deductible contribution, making your conversion entirely tax-free. This reverse rollover must be completed before December 31st of the year you perform the Roth conversion to avoid the pro rata rule for that tax year. Finally, accurate tax reporting is paramount. This multi-step process requires you to file IRS Form 8606, non-deductible IRAs, with your tax return. You'll report your non-deductible traditional IRA contribution on Part 1 of Form 8606. Then, you'll report the conversion on Part 2. This form informs the IRS that your initial contribution was made with after-tax dollars, preventing them from taxing you again on those funds during the conversion. Failing to file Form 8606, or filing it incorrectly, can lead to your conversion being incorrectly categorized as fully taxable, resulting in an unexpected tax bill and potentially triggering an audit. It's highly advisable to use tax software or work with a qualified tax professional to ensure this is handled correctly. The Backdoor Roth IRA isn't merely a loophole, it's a strategic pathway designed to allow high-income earners to participate in the incredible benefits of a Roth IRA, a benefit they would otherwise be denied. By consistently contributing the maximum each year, $7,000 for 2024, and letting it compound tax-free for decades, you can build a substantial tax-free retirement nest egg. Imagine contributing $7,000 annually for 30 years, achieving an average 8% annual return that could grow to over $800,000, all accessible completely tax-free in retirement. This is a powerful advantage that can dramatically impact your financial independence. While the Backdoor Roth IRA provides immense value, it's just one piece of a comprehensive financial strategy. If you're looking to explore other advanced tax optimization techniques and supercharge your wealth building journey, dive into our next video on advanced tax loss harvesting strategies. Your future self will undoubtedly thank you for taking control of your financial destiny today.